Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome a special guest, and that's economist John Adams. How you going, John?
Good, mate. How you going?
Good, thank you. You've been in the media a lot lately, and you've been talking about this housing correction and economic Armageddon. So we're going to unpack those ideas and talk about everything that's going on. But for those that haven't followed your work, what's your background?
Sure. Yep. So, trained economist, bachelor's at University of New South Wales, did honours at University of Wollongong. Had a very sort of interesting career. Worked for the coalition. Worked for Senator Sinodinos, 2012-13. So, been an economic political advisor at Parliament. Worked for Ernst & Young as a management consultant. Done a range of things there. Done a lot of writing. News Limited. Done quite a few articles about economics and politics. Worked as a public servant, and yeah, I think it's like just been tracking this economy and the bubble that we're now in. And starting from about 2016, I said, no, well, I've got to warn people because there's a whole bunch of vulnerable people out there that have just signed up these massive mortgages, and there was no alternative voice to say that something's wrong here. So that's where I started to be more public, started with the Daily Telly in Sydney, writing several articles for them. And then I started doing a few things with news.com. And, throughout 2017 and 18, we came up with this series of articles around economic Armageddon. So it's a basic thesis that we're headed towards a systemic economic crisis in one form or another. So we've put forward a range of scenarios as to what that looks like. And since then, starting about halfway through last year, started doing a range of interviews with Martin North, and we did about 35 episodes last year. We've done another 10 or so episodes with our new channel In the Interest of the People that we started off this year. Decided to put my own website together, so adamseconomics.com, which has my full catalogue of work on everything that I've ever done around economics, politics, public policy, and a few other things. So all the videos, all the articles, and I continue to write stuff there. And so for about now 10 months, since about July last year, I joined up with a gold and silver dealership, so as good as Gold Australia. So I'm their chief economist. So I do a range of articles, do a range of videos for them. We did a seminar in October last year in Adelaide, and we've got a range of seminars coming up. We've got next week in Melbourne, 2 weeks in Sydney, and then halfway through May we have one in Adelaide. So yeah, it's all about getting the word out there, because you look at how this housing market's going, and it's starting to crater. A lot of people already in negative equity. I'm hearing some very bad news, particularly out of Melbourne, and a lot of Australians struggling with debt.
Yeah, and I'm going to talk about. I'll play devil's advocate a little bit today. We'll talk about the Melbourne and Sydney versus the rest of the economy. We'll talk about gold and silver a little bit as well. But I guess to start off with, in 2008, the GFC, that's when I got into investing. And a lot of people were saying this can't go on and everyone's in debt. And then here we are sort of 11 years later, people are kicking the can down the road. So when did the debt alarm bells start going off for you? Is this especially in Australia recently? Or I guess people are saying, why can't they keep kicking the can down the road?
Sure. Yeah. So, I probably started getting concerned about the official data probably about 2008, 2009. The reality is that you go to a university in this country and they teach you Keynesian economics.
Yeah.
And in the Keynes world, the Keynes framework, you don't really understand about money. You don't understand about debt. You don't understand how debt's created by the banking system, how debt bubbles form, how they collapse. So all of this sort of stuff is not taught, and so it's very easy for a whole bunch of mainstream economists to have missed the GFC coming. Although you had Steve Keen, basically was sounding the alarm bell then.
Yeah.
So I started getting concerned, particularly when I first joined the public service in around 2007, 8, 9, and then when I went to the Hill, worked for the coalition in opposition. Sinodinos, who's an economist himself, we had numerous conversations about, the structural integrity of the economy. So generally, you expect the economy to look a certain way if it's healthy, but we've got a number of what I would call structural imbalances. There's a number of abnormal things about the Australian economy,
100%.
Which are not sustainable, which are not normal. So the concern sort of reached a point where I said, well, no one's really talking about this in 2016, and I need to say something. So that's when I decided to go public.
Fantastic. And we've done a documentary recently about this. Martin was in it as well. And it is noticeable the private debt, the household debt of Australians. So a lot of people say that, this is Sydney and Melbourne that have brunted the worst of it, but that makes up 70% of the mortgage market. So how do you see this spreading? Is it going to spread to regional areas as well? Or is it just Sydney and Melbourne alone, those big corrections in price will be enough to drag down and have those spillover effects into the economy?
Sure. So when I talked about Armageddon, the question is, well, what is Armageddon? I mean, I had several federal parliamentarians call me up last year and express concern about falling house prices in Sydney and Melbourne. And I've always said that the financial crisis is not house prices; it is about the debt. Now, in Australia's case, the bulk of the debt is tied up in property. So when you look at, say, credit to housing as a proportion of GDP. 1991, it was around 21%. We're at close to 96, 97% now. So we've had a massive increase of debt. It's all tied up in property. And basically, what you've seen is, particularly in the employment market, you've seen a lot of people being sucked into this bubble. So, about 300,000 extra construction jobs have been created. Got a lot of people in retail, hospitality. A lot of people have gone into the mortgage market, the debt market, into finance market, the banking industry in terms of jobs. So house prices falling in and of themselves, I mean, that's not necessarily the main game. The main game is always when the debt becomes a problem. Now that we've seen, so we had, now the reason why people like Steve Keen was sort of wrong in 2008 when they made the call was because what they didn't anticipate was the ability of the banks and the policymakers to increase credit growth to housing. So what drives property prices is how much debt you can pump into the system. And we had a dip in after the GFC. They cut interest rates from 7.25% down to 3%. They had the first homeowners boost. They had the stimulus package. We had the China mining boom Mark II. Yeah. So we had a number of things that stabilized the market and pumped it back up. And then we had another dip in credit growth to housing in 2013. Well, they cut interest rates from 4.25% down to 4.75% down to 1.5%.
Yeah.
So so you had that. You had a flurry of interest-only loans. You had a flurry of investor loans, and the more important thing is, which the mainstream media won't admit to, is you had systemic mortgage fraud. So a lot of the debt that was signed off was basically outside of the scope of the law. And this is why, since about September of 2017, credit growth to housing has gone through the floor. Because once the banks got a whiff of that the Royal Commission was coming, a lot of these practices got cut out. And about 40 to 50% of the market can't qualify for mortgages when previously they could, because the income verification, expense verification, asset values, a whole bunch of things. I mean, the law requires the banks to ensure that they're confident that the people can make these repayments. Well, a lot of these things were not done in the pre-Royal Commission days, and now they've sort of really tightened up their practices, and that's obviously means that less people can qualify for debt, and that's basically why house prices are falling. Now, what we're seeing at the moment is that we're seeing that in terms of potential new sales, there's a whole bunch of new developments that are struggling to get finance. A lot of people can't sell these developments, so you're starting to see examples of people getting cut back on hours in the real estate industry, the construction industry. Unemployment in New South Wales and Victoria have ticked up according to the latest statistics. And if this sort of continues, if people if their incomes start to continue to reduce, or if they are actually out of work, that's when debt serviceability becomes an issue. It'll start to get into the banks, and then we're off to the races.
Yeah, and one of the things we touched on was the number of interest-only loans and investor loans, and now they're all coming up to be rolled over. So at the moment, arrears rates are relatively low, but do you see them increasing, and what sort of numbers do you think we're gonna see, and how does that then spill over and worsen the economy?
Yeah. So on a relative basis, I mean, arrears are low, although you should say, it's fair to say that the arrears rates are going up. Now, particularly around the 30-day arrears. I mean, Martin North was in the media in the last fortnight. There was a bit of a debate as to what's the appropriate measure. The banks looked at the 90-day arrears rate, which is still fairly okay. But the 30-day is showing increases in arrears, and that's what sort of Martin's focusing on. And obviously, the reason why Martin's important is he has his own independent data set at Digital Finance Analytics. Mortgage stress, more than 1 million households in terms of stress, and people are trying to struggle. But the key thing about arrears is, so arrears, defaults, and unemployment, I mean, these things come at the end of the process. So now, a lot of people in the mainstream don't want to compare us to Ireland, and they basically say, well, too many differences. And then you get people like Shane Oliver from AMP says, well, they try to compare us to the Americans, and we didn't give out these ninja loans. We didn't have irresponsible lending. Now, the Americans gave loans to poor people who couldn't pay, whereas the Irish didn't do that. I mean, the bulk of the people in Ireland who held the debt were middle to upper income people. So people with high incomes held the bulk of the debt. Well, that's exactly what we have faced. Now, there's a guy that I've done some recent work with at news.com, with Eddie Hobbs. Eddie Hobbs is a financial advisor in Ireland. He called the housing crisis a few years before it happened. And I've been on the phone with him many times to actually ask him, what are the early warning indicators that you should see of a systemic collapse in the housing market and the economy before you start to see arrears and unemployment? Because these are things that happen at the end of the process. So there's a whole host of things that the people in Ireland, I mean, so there's Irish citizens in Australia who I've spoken to, particularly in Melbourne, that said it feels very much like Ireland, and they've given me their own experience as to what were the sort of early warning indicators that they saw in Ireland. But also, particularly talking to Eddie over there, he's given me a checklist of, say, if you see these things, you know that things are starting to fall apart. And things around severe cutbacks in consumption. So new car sales are down, new sales around furniture, sales around
household staples, I think, is one of the other ones I've been watching that's been falling.
Yeah, exactly. So you're starting to see falls down in terms of and there's various consumer items. One of the things that they saw in Ireland was people who had their kids in private schools. They struggled to pay the school fees, and they went in to renegotiate fees. So I've had several sources in Melbourne saying that at certain of the exclusive colleges, the parents can't pay the fees. They started to pull their kids out of that. I've heard examples of people reducing their level of private health insurance. So I mean, you're starting to see, particularly in Melbourne, a severe tightening of their expenditure. But also you're starting to see panic, and this is one of the things I raised in a recent debate when I went on Peter Switzer show against Christopher Joy around panic. Now, there's a whole host. I mean, if you look at the number of listings in Melbourne, it's risen by 25% in the last 12 months.
Yeah.
And so households with a big amount of debt, and particularly if they're in negative equity, they're trying to unwind these positions. And if everyone does it at the same time, it just crashes the market. And you're seeing the early signs of that in Melbourne. But the interesting thing that I heard in the last week is, there are some examples of people with very high levels of wealth, very big portfolios. One example of, there's a doctor on about $350,000 a year. They've got a 12 property portfolio worth about $12 million, no debt, but he now wants to sell it all because he's afraid of losing about $4 million in equity. So once you start to see these examples of either people with no debt or people with debt rushing in a stampede towards the door, it's going to crash prices, and then you're going to start to see unemployment go up. A lot of examples around negative equity. And the banks, particularly in Melbourne, are starting to force people to go into liquidation, and yet you're going to force people to go into bankruptcy. So my fear around this Armageddon thesis has always been, which has been what we've done for 200 years, is the world blows up in one form or another, and we're not ready, and we get swept through the process. So that's what happened, in the GFC in the 1970s, the Great Depression, 1892. Something blew up overseas, and even to some extent with the Asian financial crisis when Thailand blew up. So that's always been the base case, that something was going to blow up overseas, because we've got the biggest bubble in Australian history. At the same time, we've got the biggest bubble in the history of the world in terms of debt. So, but in the last a few weeks, we've put Martin North, myself, and Eddie Hobbs, we put this thesis out to say, well, rather than waiting for the shock, we could be the shock that blows up the world, because we're starting to fall apart. And the question is, well, it's the mainstream are saying that we're going to have a soft landing. It's all going to sort itself out. Well, there's the early signs to suggest that may not be the case.
Do you think this is just concentrated in Melbourne and Sydney, though, where prices got ridiculous? And what do you say to people that say immigration growth is so strong, particularly for those two cities?
Well, yeah. So about 60% of the property is in Melbourne and Sydney. So we have seen Perth fall about 17% from the peak, which was in 2015. Darwin's fallen about 20%. But yeah, I mean, but the main game is Melbourne and Sydney, and so we are seeing more examples of people struggling with debt. Their wealth is evaporating. And even in some of the more elite suburbs, like in Melbourne, like Hawthorn and Camberwell and Brighton. I mean, you've got a whole bunch of people what I would call the fake rich. So people who pretended to be rich by leveraging up, and now some of these people are really struggling with their debt loads, and they're in massive negative equity.
That's an interesting point, because at one point there we had those loans, interest only and investment, getting up towards that sort of 40% number. And I'm wondering, when all this unwinds, is it actually going to be that middle and upper class that's speculated so much on property that gets burnt more than someone that might live in a pretty low price family home right out in the suburbs?
Yes. So that is exactly what happened in Ireland. Upper to middle class income people that leveraged up, they're the ones got smashed. I mean the workers who had debt but didn't go overboard in Ireland, I mean they were spared of the worst of it. But no, particularly in Melbourne, I mean some of these southeast elite suburbs, people who wanted to live a lifestyle that they never had the money for. These are the ones that are suffering now, and these are the ones that are going to be completely financially smashed.
So just to change gears a little bit, how are governments going to react? In 2008, we saw those massive government handouts. I was at uni at the time and I got a couple of those. Didn't really understand what it was at the time. But do you think that governments are going to go crazy with the money hose and helicopter money, as we've heard central banks talk about? And what are the side effects? And is this why we're starting to see other central banks globally buy up gold?
Sure. Yeah. So in terms of what what are we going to do? Well, So when I've gone down to Parliament and had a chat to several parliamentarians or advisors, I mean, the main focus is saving the banks, because if the banks go bust, we'll have the biggest depression in Australian history, because the amount of debt is more substantially larger than 1892. And 1892, if your viewers haven't realised, that was a worse depression for Australia, particularly Melbourne, compared to the Great Depression, because our banks went bust. Yeah. So once debt serviceability becomes an issue in Melbourne and Sydney in particular, and that starts to infect the capital reserves of the banks, then it's a matter of how do you save the banks? Well, the Reserve Bank's already on the record. They're going to go to zero. They're going to do quantitative easing. Yeah. It looks like Labor's going to be elected. Now, Labor, from the sources I have heard, I mean, they are willing to roll out the same sort of package that they did 10 years ago in the coming crisis. But Labor's anticipating a global shock, just like I said previously, and there's not a lot of thinking in Labor as to we may go first. So there's a couple of risks there that I think a shortened government will have to manage in terms of moving forward. But yeah, they will do anything and everything to save the banks, because if the banks fail, we'll have depression. Now, when I've spoken to people in Parliament, they say, well, how are you going to save the banks? Well, now, obviously, there's a big controversy around what happened with Cyprus, around this confiscation of deposits, bail-in. So Martin and I have done some sort of pioneering work in that area. The law is very vague. There's potentials for bail-in of retail deposits, we believe. The government can do a lot of things to make things clear, tighten up the law, but they won't do it for I think, the obvious reasons. Now, if they don't do, and certain parties in Parliament, like the Greens, are completely against bail-in. And the question is, well, if depression's off the table, if you're not going to confiscate deposits to recapitalize the banks, well, how do you do it? Well, it goes to nationalisation. So just like what happened in the UK, what happened in Ireland, what happened in the US, etc. So bailing out the banks. And the question then becomes is, well, I've said, if one of the big four banks comes to Parliament, comes to the PM, and they need like $300-400 billion in order to ensure that they don't go bust, well, where are you going to get the money from? Well, they've said to me, well, in a financial crisis, we have to take the least worst option, and then the least worst option requires us to print the money and bail out the system. Well, we've got to do it because we've got no choice because the depression is completely off the table. And I said, well, if you're going to print $400-500 billion, well, what does that do to the dollar? Well, they've said, well, we'll have to worry about the dollar later. So it's like, well, if that's the attitude of Parliament, and to be honest, it's not just like one side. I mean, I've spoken right across the spectrum, from Australian Conservatives to One Nation to the Coalition. There's no one in Parliament today who's advocating for a stable currency. Everyone thinks that they can do QE, they can print, they can take interest rates to zero, they can spend like drunken sailors in Canberra, expand the balance sheet as the Reserve Bank says, and there's no risk to the currency. Well, I think there's a big risk to the currency because.
And where do you see that going, John? Like back in I think it was the late 90s when the Aussie dollar bottomed in the 40-cent range. Are you talking about revisiting those lows, or is it somewhere in between?
Sure. Well, look, so a lot of it comes down to the confidence of our creditors. So if you look at Turkey last year, Turkey fell about 32% in 3 weeks. If you look at South Korea in the Asian financial crisis, they fell 40% in 3 weeks, their currency, until they got an IMF bailout because basically the creditors didn't have confidence we could meet our foreign debt obligations. So we have $1 trillion in net foreign debt, about 57% of GDP. The IMF has said that once that figure gets above 50%, the level of systemic risk in the economy actually rises. So it's all a question of confidence. Now, the question is, we've built this lifestyle in Australia thinking that this is normal, but it's not normal, and it's been all based on borrowing from foreigners. Once the foreigners realise that we can't pay the debt, and we can't pay the debt, could the currency fall to 40%, 40 cents against the US dollar, 30 cents? I mean, it could be a very dramatic fall. Could we need an IMF bailout? I mean, it could get that bad, but there's not a recognition by the government, the Reserve Bank, or the mainstream media about how systemically risky in terms of our position is, and that's sort of why. I mean, I've been buying precious metals for about 2.5 years. I've been positioning my family's portfolio along those lines because I don't see any form of sanity coming out of Canberra or Sydney in terms of how do you manage this quantum of debt, and how do you sort of try to rectify some of those issues when you've got this massive foreign debt issue and you've got foreign creditors who could easily lose confidence. Because you think the gross foreign debt, about 2.3 trillion. Well, $500 billion of that is 90-day paper, and that's concentrated in the banks. So the banks get in trouble, and there's a risk around the banks. Well, we've got to turn over $500 billion in 90 days. Well, if the global interest rates start going up, we could easily get into a position where we have a balance of payments crisis, current account blows out, and the dollar goes through the floor.
And globally, I keep saying at the moment the US is the cleanest dirty shirt in the laundry. They've got $22 trillion in debt, but at the moment their economy is chugging along okay compared to Europe that seems to be having trouble. Developing nations are flooded with debt in US dollars and their currencies are weakening. So do you just see this as a race to the bottom ever since QE started? And I guess that's why we're so interested in gold and assets like Bitcoin in some of these other countries that don't even have a good banking system. We're already seeing up to 50% of transactions take place in Bitcoin. So I don't want to dive into the cryptocurrency side of things too much today, but do you see all those currencies racing to debase and to pay down their debt?
Of course. I mean, look, yeah. So there's a lot of risk around in terms of the world. I mean, there's risk in the Japanese, the Chinese economies, the Eurozone, and the US. So it really is. So there's nothing healthy in the global system, but it's just a matter of degree. It's a matter of in terms of what is relatively good, what is relatively bad. And so so I think it's fair to say that the Europeans are in far worse shape on a relative basis compared to the United States. I mean, there's a lot of people that are saying that the euro currency is not going to be sustainable. The Italians are in awful shape, and the Spanish, the Portuguese, the Greeks, etc. So so I think it's a matter of time. I mean, they're already at 0% interest rates. They said they were going to lighten up on QE at the end of last year. Now they reverse that position because I mean, how can the Italians continue to finance these massive deficits? I mean, it's the European Central Bank. I mean, they're printing all this money, they're buying all the bonds, and if they stop QE, I mean, the yields on the Italian bonds will skyrocket, and the Italians will default. I mean, Europe is an absolute powder keg ready to explode. But so far, the European Central Bank has been to keep it together. And the question will be what will be that trigger that will blow up the global debt bubble? Well, Australia potentially could be a catalyst. Canada is obviously in bad shape. There's a lot of bad debt in China. Obviously a lot of bad corporate debt in terms of the US. But then you've obviously got a whole host of problems with public sector debt in Southern Europe as well. So, I mean, look, I've had questions for the last 2 years. When do I think this is going to happen? Who and how and when? And I've sort of said that, theoretically, could happen today. It could happen tonight. If the European markets open, if Deutsche Bank says we're done, or if one of these other sort of banks or your government says we can't pay, well, the markets will melt very quickly within days, and spread throughout the financial system. Contagion, credit freeze, new global financial crisis. So it doesn't take much for it to happen, and so that's why I've been an advocate to make sure you get your house in order as quickly as you can, because when it really counts, if you're not ready, you're done.
And I guess the positive scenario and what's caused such consistent growth over recent decades is, a good growing working age population. But all those demographics are changing now, particularly across Europe and Japan, as you say. I just don't see where we can sort of grow our way out of this, and we've taken on all this debt, and the interest rates are what's really starting to hurt people and countries. And the other way to get out of it, as Steve Keen talks about, is governments need to pick up the slack, particularly in a country like Australia where government debt isn't huge, but they're never going to do that. There's all this talk of fiscal responsibility and not going into debt, and we have the two-party system butting heads about how they're each sort of wasting money. So, I just don't see a scenario where we can sort of get out of this easily, and maybe sideways for 20 or 30 years is a Japan scenario.
Yeah. So I mean, I'll just disagree with you slightly there. So now, I mean, the coalition said that they're going to have a surplus. Now, when you study the budget papers that came out a few weeks ago, and I was on the phone with 2 coalition MPs last week, and I said your government committed mass fraud. I mean, if you look at the assumptions behind the budget, I mean, there's several things that are very problematic. The budget assumes that this slide in the housing market will have no impact on GDP, on Australian GDP, will have no impact on unemployment. That's complete BS. You look at their assumptions on wage growth. Well, this wage growth, the assumptions around that, it's been fundamentally flawed for about 8 or 9 years. This comes out of Treasury. I mean, both Labor and the Coalition have completely stuffed up these forecasts. And again, as a very rosy, optimistic picture on wages growth, that's not going to happen. Look at the assumptions on Chinese economic growth. Now, Beijing saying they're growing to 6 to 6.5%. The IMF has accepted that, and that's what we've put in our budget. That for 2019, China will grow at 6.5%, and then for the next 3 years, they'll grow at 6%. There's 3 independent studies that says that Beijing has been lying about their economic growth numbers, and that there was a Chinese professor late last year that said it was less than 2%. Other studies have said it's about half of what the Chinese claim. Well, but also look at the inverted yield curve. So on the 22nd of March 2019, the 1 to 10 US yield curve inverted. The last 7 recessions, when that happens, you have a recession anywhere between 3 to 27 months. So look at the forecast for US economic growth in the federal budget. No recession. So there's enormous amounts of bad or faulty or fraudulent assumptions in the budget. So I don't have any confidence that we're going to generate the growth and the tax revenues the government says we're going to generate. And I'm very skeptical as to whether we'll get a surplus. Now, obviously, if we have a more systemic crisis, now, Labor will spend. Labor is telling people privately will spend. They will go massively in the red. They won't cut back on spending. There are some voices in the coalition backbench that have said that they will oppose any forms of stimulus coming out of a Morrison government, but they admit that the first impulse of Morrison and Frydenberg is to spend. So now the thing is, like, can we increase public sector debt as a proportion of GDP? We can. So we're at a reasonably low number relative to everyone else in the world. Can we dramatically go high? We can. Can we kick it down the road for a while? Perhaps. But if Canberra gets out of control, if we spend too much, given that we've already got a massive amount of foreign debt, again, it goes to this question of how do our foreign creditors view economic management in this country? And in the last time where federal finances and the balance of payments got into difficulty because our creditors lost a bit of confidence, well, that was in 1985, 1986, and this is where Paul Keating went on the John Laws program and said, we're on the verge of becoming a banana republic, and he galvanized public support around having a tough budget in 1986, and he was able to produce 3 surpluses from 87 through to 89. So I don't think there's any hope of fiscal responsibility coming out of Canberra. It's a lot of fraud in terms of the assumptions, in terms of what they think the economy's going to perform, and obviously, look at the campaign. It's just more spending commitments, and everyone thinks that money grows on trees. So I think we're going to see an increase in the size of the deficit. I think it's going to be potentially inflationary. It's going to be bad for the dollar. And obviously, if there are people who lack confidence in the dollar, you need to look at other alternatives that's going to hold value. So, I'm in the sort of gold and silver space because it's been tested and proven for 5,000 years. There are people in the crypto space. I think crypto is exciting. There's a lot of believers, a lot of skeptics. And I think it's fair to say that crypto is yet to be tested in a severe financial crisis. But yeah, people are looking at Bitcoin, Litecoin, and in terms of some of the other coins, and it is an area that I continue to educate myself on. But I think whether it's crypto or gold and silver, I think that the appetite for these forms of money or currency will continue to increase in the years to come, 100%. Because there's no responsible economic management coming out of Canberra or Sydney.
I think that's a fantastic place to sort of wrap it up there, John. We completely agree with everything you've said there. And Steve and Martin have become friends of the channel, so I'm sure you'll become a friend of the channel and come back on again in the future. But any final messages for people at home? I'll put all your links to follow your work in the description below as well.
Sure. Yeah. So in terms of the final message, basically everyone should do their own homework. A lot of people are struggling with debt. There are some independent voices out there saying that the picture's not rosy. Saying to people they need to take action today. And when I say today, literally today, to try to resolve some of the financial issues in terms of the balance sheet. So I have a website, adamseconomics.com. It's my full body of work. I'm fully transparent with all the views that I've put forward. People feel free, public site, you can come and read this stuff. But yeah, I think it's very important that people try to educate themselves and try to make the best decisions they can, knowing that we're just hearing propaganda from the government and the mainstream media.
Yeah, and between yourself, Martin, and I will continue to help the Australian public as much as we can. So thanks so much for joining us today, John.
Thank you for your time.